Have you ever met someone who will drive across town to save a couple of dollars on groceries, but doesn't think twice about spending hundreds of dollars on a fancy dinner at a high-end restaurant? Why do they behave like this? Well, it's all about mental accounting. Let's take my friend, Mr. J, for example. He's heading to the concert, all excited, with $200 ready to buy the ticket. But suddenly, oops, the money is gone. Now, Mr. J thinks, well, I guess I can't go anymore. Why? Because that $200 was in his entertainment account. And once it's lost, Mr. J feels he can't spend any more from that account. Now, let's imagine another scenario. Mr. J realizes he has lost his $200 bus card. Does he give up on the concert? Nope. He decides, I'm still going, and buys the ticket anyway. Why? Because this $200 was in the daily expenses account. And losing it doesn't stop Mr. J from continuing with his plans. This is mental accounting at play. We naturally divide our money into different categories and allocate a set amount to each one. So, once we lose the $200 meant for a concert ticket, we feel like that $200 has already been used up from our entertainment account, and we shouldn't spend any more from it. But if we lose a $200 bus card, we think of it as money taken from our daily expenses account, and the money in the entertainment account remains untouched, still available for fun. The differences in mental accounts go beyond just categorization. The amount of money people are willing to spend in each mental account can vary greatly, depending on their preferences, personality, and financial situation. For example, some people may allow themselves to spend more on travel and vacations. Others prioritize education or personal development, while some are more willing to allocate their money toward daily expenses. Let's talk about a special mental account, the emotional account. Take diamonds, for example. Are they truly rare? Not really. De Beers crafted the illusion of scarcity and cleverly linked diamonds to love and commitment with their iconic slogan, "A diamond is forever." For Mr. J, a diamond isn't just a shiny rock. It's a symbol of his love and commitment to Ms. T and emotional investment. The real value of a diamond comes from the emotional account. By connecting diamonds to love and meaningful moments, retailers make us feel that buying one is much more than just spending money. It's about creating lasting memories. This is why, during Christmas, almost every product is packaged as a gift. It's why, on Valentine's Day, roses are sold for sky-high prices and still often in short supply. This is all a clever use of the emotional account. By attaching emotional significance to something as simple as a flower or a piece of jewelry, retailers make us willing to pay more because we are not just buying a product, we are buying a meaningful moment. Besides the money we spend being categorized into different mental accounts, the source of our income also plays a significant role in how we allocate it. Different types of income tend to be assigned to different mental accounts, which affects how we choose to spend it. For instance, Mr. J worked hard for 3 days and earned $500 as a reward. Would he spend that on a slot machine? Probably not. But what if he found $500 lying on the street? He'd probably think, why not? He'd be much more willing to spend it because we have a more generous attitude toward unexpected income. As the saying goes, easy come, easy go. It's money we didn't work for, and we feel freer to spend it. This is exactly why, in casinos, you rarely see people stopping while they're ahead. Once they win, that money is placed in a separate mental account, the unexpected income account. People are more inclined to spend it because it doesn't feel like real money. It's not money they worked for. It's money they got easily, so it feels more acceptable to spend it. Even when it comes to regular income, like wages or bonuses, people tend to have different attitudes toward it. Have you ever heard of those lottery winners who, after a few years, find themselves back in poverty? This happens because they start treating their newfound wealth, their unexpected income, as money that can be freely spent. And they don't have the same financial discipline they would with money they worked for. So, what does this tell us? Mental accounting shapes how we perceive and spend money. We assign different values to the same amount depending on how we categorize it, whether it's entertainment, emotional spending, or unexpected income. By understanding these mental accounts, we can make smarter financial decisions. It also explains why we sometimes spend too freely or hesitate, even when we can afford it. Businesses know how to leverage these accounts, packaging products as luxury gifts or offering buy one, get one free deals. taps into our emotional or unexpected income accounts, making us more likely to spend. Next time you feel tempted to buy, ask yourself, do I truly need this, or am I just swayed by a good deal or emotional attachment? A little indulgence is fine, but being aware of these tactics can help you spend more wisely. Thanks for watching, and remember, money is money. No matter which account it's in, its value remains the same. But how we treat it depends on how we categorize and view that money. Take charge of your financial journey. Start by understanding how your mind works with money. See you in the next video.